Hey guys, welcome to today's show. So I'm going to jump in and we're going to talk about Bitcoin, Ethereum, MSTR, BM&R, but overall, I'm going to give you a general outlook of what's happening in Q4 as it relates to the dollar, as it relates to Bitcoin potentially following gold, and as it relates to liquidity coming back into the system. So I'm going to give you some technical analysis on research that was done by Fundstrat, which is a very, very reputable firm, and I'm going to show you some data. And you can decide whether we're going up from here or whether we're going down. The data points to us going up, and I'm going to let you make the decision. Not financial advice, not tax advice, not legal advice. And we're going to jump in right now. Also, if you want information on how I'm trading during this market, yesterday I picked up about 100 shares of BM&R when it dropped. Because I'm trading every day and I'm picking up more shares even when we're in a bearish sentiment. So that's all down below with my book. You can snag it and you can get that for free. And I'm averaging about 5% per week at a minimum trading and profitable the last 15 out of 16 weeks. So let's get into the data right now and let's take a look. So something's happening that's interesting between gold and Bitcoin, and it could signal the next rally here. So here's the chart. We'll come back to this in a second, but basically it shows how Bitcoin lags gold. So gold goes up first, and there's a 60-day lag between gold and Bitcoin going up. So if you look at this over the past few months, gold has been the preferred debasement trade, meaning people don't have confidence in the dollar, your money supply. In the US, even in other countries, you've got the money printing on average in US 6.5% on average every single year for the last 100 years. So currency is being debased. That means when you go to the grocery store, your money buys less. When you go to buy a house, your money buys less. So people are moving into gold as a result. And so the preferred debasement trade bouncing hard after hitting resistance near 4,400. So gold, people were rolling into, hit 4,400, and then it pulled back. It's been a safe haven for people who are diversifying away from the US dollar, right? So people are not confident in the US dollar, so they're moving into gold, with central banks around the world quietly increasing their gold reserves as well. So, but here's where it gets interesting, okay? When you overlay gold and Bitcoin's rolling 60-day returns, you have a clear lead and lag relationship that's appearing on this, okay? So historically, gold's performance tends to lead Bitcoin's by several weeks, which basically means when gold breaks out, Bitcoin often follows. So you look at the chart, and I'm going to show you the chart in just a second. The black line represents Bitcoin's 60-day returns, and the blue line shows gold. So when you go look at this, you got the black line here represents gold. So if you look here, you've got gold. If you look at the arrows, you have gold leading, and then you have Bitcoin that's lagging, and then eventually it catches up. So you've got gold on the blue, and then you've got Bitcoin on the black. And so typically you'll see a move with Bitcoin after gold moves up. So there's about a 60-day lag. So that means gold just moved up again, and then based on the 60-day pattern, it's now Bitcoin's turn to move up again because it lags by 60 days. So that's what should eventually happen. We will see if it does happen. I'm just giving you the data. You make your own decisions on this, but I think that's what's going to happen. So the relationship is syncing up again. You got gold rising first, and then you got Bitcoin following. Okay, the rotational pull of this with this trade could push Bitcoin higher. This is data based on Fundstrat's research. That's Tom Lee's company. So it could push Bitcoin greater than $160,000. Okay. So right now, gold sits around 3,900 per ounce, and Bitcoin trades near $101,000. If gold drops just 5% through year end, and Bitcoin regains its historical ratio, which is about 30% of gold market cap, the rotation alone implies about a 40% upside from the current level. So that means greater than 160 isn't really real on that. If you look at 101 right now, a 40% upside would be about 140. Okay. So potential of a 140K upside for Bitcoin from here. So that means And if gold to Bitcoin ratio fully reverts to its all-time high of 29-30%, the model projects a target range between 160K and 175K, okay? I'm not saying this is by year end in particular. It's just whatever happens with this ratio, but this is FundStrat's research on what they think could potentially happen. So in their mind, if you look at the base case, there's a potential 40% upside on this from where Bitcoin is right now. Bitcoin was at 101 yesterday when I made these slides, and right now it's nearing up towards about 104. It's like 103 and high change right now. So based on FundStrat's research, again, this is just based on patterns historically of the gold to Bitcoin ratio. And if you're just joining us, it just shows that gold typically runs up, and 60 days later, there's a lag and Bitcoin catches up and Bitcoin eventually runs. Now, we have not seen that with Bitcoin yet at all. In fact, we've seen the reverse where Bitcoin's going down. But if it's correct and history repeats with the Bitcoin and gold ratio, then that means Bitcoin would follow next, okay? So for context, the original price target the FundStrat had earlier this year, which is Tom Lee's company, they had an original price target at the end of the year for Bitcoin between $160,000 and $175,000. I think that's extremely bullish and bullish. But maybe if we have a run up comparable to Bitcoin following gold's lead, maybe we hit 140. That to me would be a very bullish scenario. Okay, the table breaks down implied Bitcoin prices based on two inputs. You have gold's performance through year end, and you have Bitcoin's share of the gold market cap. Okay, so even if gold stays flat, Bitcoin could rise 30% to 40%. Okay, if gold rallies more, then you have a higher upside for Bitcoin. So this is just in simplicity. It's like, here's the ratio between gold and Bitcoin. Historically, these two have not moved together, but Bitcoin moves after gold moves. All right. So let's see if this happens. Again, just data, just history. We could go, below 100,000 like we did yesterday. We have a nice upside running right now. If I look at Bitcoin right now, we've got a nice run up. On Bitcoin, which is 103,583. It was down to like 98,900 yesterday. So super volatile. It's got a nice floor of about 100,000 of support. So we'll talk about that. But that doesn't mean that Bitcoin couldn't drop down to 95,000. So beware, do your own research. Okay. So weaker dollar, stronger Bitcoin. Here's why Q4 could be a liquidity driven breakout for BTC. Okay. So let's talk about the dollar. Again, this is just data and research. I think FundStrat's a very reliable company. So this is the data that they gave, and I wanted to share it with you guys. Okay. So lower rates, as we know, when there's lower rates, more money goes into the economy because it's cheaper to loan money. So there's cheaper money, and then there's more money in the economy. And so banks are loaning more money out at cheaper interest rates, and also people's current loans when rates are lowered, like their car loans and their mortgages and the interest that they pay. That lowers, and so they have more free cash flow in their pocket. So all of this has potential for more money being injected into the economy, more money potentially going into people's pockets, which means people would potentially put that money into risk-on assets like Bitcoin or BM&R or Ethereum or MSTR. Then you have foreign exchange diversification. So people are putting their money into foreign currencies. So anytime that happens, you get a weaker dollar. So why is it good to have a weaker dollar? We're going to talk about that in just a second. So either through lower interest rates or through global capital flows, meaning money moving to other currencies or other parts of the world, and people taking their money out of the dollar and putting it there, the dollar is weakening relative to other currencies. And so Bitcoin thrives in that regime. So if the dollar weakens, Bitcoin typically goes up and thrives. All right. So if you plot Bitcoin's year over year returns against the Dixie, Bitcoin generally lags large moves in the Dixie. So you can see that there's a clear inverse relationship. When the dollar falls, Bitcoin actually rallies, and you can see it here on the charts, right? So it's inverse. So it's different. Like when gold, in the gold scenario, when gold goes up, 60 days later, Bitcoin typically rallies. In this scenario, when the dollar weakens, Bitcoin goes up. So there's an inverse relationship. The opposite happens. Dollar gets weaker, Bitcoin typically goes up. That's history, okay? So you can see that inverse relationship here on the charts. If you just look at it, you can see it. All right. Okay. So there's that. It's not instantaneous. There is a lag on that. So the lag's typically about 90 days. And we will see if that repeats itself. So when we offset Bitcoin's returns by that 90-day period, the pattern becomes obvious, and Bitcoin generally lags major shifts in the dollar. So you got two indicators now. You got a weakening dollar, and you also got gold going up. And those are two indicators that Bitcoin could go up into the future. So right now, the Dixie signal has turned bullish for Q4. So historically, that's what we see. That's when we see some of Bitcoin's strongest multi-week runs, as global capital rotate and it goes out of cash and then it goes back into risk assets. So we will see if that happens, because everybody's been expecting it, but we've gotten the reverse, which is pretty sad. So we want to see the actual good thing happen, which is Bitcoin to go up. You got another critical driver. If you're just joining us, I'm talking about just data and statistics. And if you look at the basic of what we've been talking about, gold goes up and Bitcoin typically rallies 60 days later. So we'll see if that's going to happen, where Bitcoin will go up versus going down. We just also talked about the weakening dollar. When the dollar weakens, Bitcoin typically goes up, and that's a 90-day lag, and it's an inverse relationship. So then you have another driver here, which is central bank liquidity, which is, the base collateral of the financial system. So more collateral means more lending, and more lending means more risk taking, a direct tailwind for crypto. So what does that basically mean? Is like central bank liquidity is there's going to be more money pumped into the system. So instead of the Fed holding on to money and tightening the supply, money goes out into the system, more liquidity, more money in people's pockets, and then people tend to invest in risk-on assets like Bitcoin or crypto, okay? So that's that data. So over the last few months, you take a look at liquidity, it took a hit in the Treasury General account, all right? And so that process basically pulled reserves out of the private banking system and into the Treasury balance sheet. So what does that mean? Like when things are in the private banking system, the banks are making loans and they're pumping money into the economy, and everybody's happier because there's more money out there and people got more money in their pockets. But what's been happening prior to Q4 is that money's been pulled out of the private banking system. So when liquidity is crunched, and when the supply of money is not going into the economy, but it's coming out and it's being held by the Fed, it's not good, because we don't have money to invest in crypto, to put it pretty simple, okay? But that's changing now. So you have the Treasury General account is rebuilt, and QT is ending. So quantitative tightening ends on December 1st. So basically what that means is, since they've been restricting the supply of money, on December 1st, they're not going to restrict it anymore, which means more money will go into the economy. And if we see another rate cut in December 1st, that would be, more money pumped into the economy, which is bullish for risk-on assets, okay? So that means there's little reason for further draining, right? We're not going to drain money out of the economy and out of the private banks. We're going to put money into the private banks so they can give loans to people and pump more money into the economy, all right? For cheaper rates. So you combine all of this with quantitative tightening, which I just talked about, right? Simple way to say that the Fed is not going to hold on to money. They're going to pump it back into the economy through the banks. With that coming to an end, and suddenly you have Q4 turns into a liquidity positive environment. So typically, crypto is not going to do well in a liquidity tightened environment. But when it's liquidity positive, that's what gives it a chance to do well. So if there was ever a chance to do well, the signs for crypto, for Bitcoin, for BM&R, for Ethereum, for MSDR, the signs are there that it can do well, okay? Which is why people are so confused, because they're like, this is crazy, why it's not doing well, okay? So that's exactly the setup that Bitcoin needs to push higher, right? This is the setup it needs, all right? On top of that, you got the macro backdrop, you got the leverage reset we just had in the crypto market, and Bitcoin open interest just dropped over 25% in a week. So basically, when the shit hit the fan and we had $19 billion of liquidations, people who are on leverage, they don't have a lot of interest after that happens in putting more leverage into the market. So $19 billion got liquidated like a month ago. People didn't learn their lesson. Then we had like another $800 billion liquidated. And then recently we had another $1 billion liquidated. But like open interest is dropping in terms of doing that. So the markets are resetting a little bit because people are like, maybe I shouldn't go on leverage anymore, right? And it's being cleaned out of the system. So historically, these resets clear out excess speculation, and they often mark the beginning of a strong upward reversal. So will that happen or will it not? Okay, so I would not say sentiment's definitely not neutral. So that's a mistake. The sentiment is very low. And people have lots of fear right now. And so we know this, but basically here's the things to give good indicators in the market. We got a weakening dollar, which is typically good for Bitcoin. Okay. We have a liquidity positive shift from the Fed and the Treasury, which basically means that liquidity is going into the market versus being held. And then we have a cleaned up derivatives market. So you got all the people who are trading on leverage and all this stuff. They got washed out and wiped out. And so now there's a reset for, the market to cleanly move up. And we don't have neutral investor sentiment. I won't say that. It's bearish sentiment. So let's just correct that. Okay. So all of this points to a more powerful Q4 setup for Bitcoin potentially, which we only got, 50 days left in Q4. So we'll see if that happens. All this except the neutral investor sentiment. It's actually bearish sentiment. Okay. So, I'm not going to show that slide, but we've officially entered the post second rate cut zone. So if you look in 2024, when we had a run, we had 2 cuts in 2024. So you take a look at Bitcoin after the second rate cut, and it goes up. And then we just had a second rate cut in 2025. And so let's see if Bitcoin goes up. Okay. If history is any guide, this is when Bitcoin usually takes off. So if Bitcoin has a chance to take off, all the indicators are there for it to take off, except, of course, the bearish sentiment. Okay. After the second Fed cut in 2024, Bitcoin rallied massively. Will that happen again? As you all know, the Fed just cut rates for the second time this year. And so we may have a third rate cut coming in December. And if we have a third rate cut coming, that would be very good. So the target range of the cut is between 3.75 to 4% in terms of the actual rate, not the cut. The cut is 25 basis points, and that's what it just was. But Powell's message hit the market hard. As you've seen in my previous videos, like no more cuts this year is basically what he said, or we're far from having cuts this year, That single line erased the euphoria from the 25 basis points move. So when you saw Bitcoin running up to 115,000 again, there was euphoria. People were thinking, hey, the Fed is dovish. There's going to be more rate cuts to the end of the year. They priced in that interest rate cut that we just had. And then when people saw that the Fed turned a little bit hawkish and the Fed's confused because of all the jobs data and the shutdown of the government, all of a sudden people turn bearish. And we saw the sell-off from 115 drop to 107, down to 101, down to 98.9, and now we're up to 103.5, okay? So stocks dipped. Bitcoin didn't really pause. It freaking dropped, and sentiment shifts. But the futures data shows there's a 63% chance of another cut in December. So despite the Fed being hawkish, where we have a chance of 62% rate cuts coming up in December. So that would be good for liquidity in the system. So Bitcoin's got a floor, it's got a powerful floor at about 100K, even though we breached that, which was scary for everybody yesterday, 98,009 or something. They've got the $100,000 floor. Here's why. You have individuals are selling roughly 3,200 Bitcoin per day, but institution and ETFs are buying more. So Bitcoin treasury companies are buying, fund and ETFs are buying. In December, or I should say in October, we had a large inflow into the ETFs for Bitcoin. We also had inflows for Ethereum. Now, we've recently seen some outflows in the last week, but overall, we were net positive majorly on inflows into the ETFs for Bitcoin. So we know the funds in the ETFs, they're buying more Bitcoin. Businesses are buying more Bitcoin, and governments and other entities are buying more Bitcoin, okay? So even with 450 Bitcoin mined on a daily basis, the demand does outweigh the new supply, which is why there's a strong floor at $100,000. Now, that doesn't mean we can't break it and go down to 95. If we would go down below 95, then we would get a very bearish sentiment and drop lower likely. But that's what creates a price floor around 100K, which we bounced off of last night, okay? So BTC ETFs, they lose $607 million. So that's what happened last week. So $607 million in outflows, but October brought about $3 billion in net inflows. So the demand was still strong in October, okay? So per fund strat, what they're saying is this is a healthy rotation. It's not weakness. And that's what they're sticking. They're sticking to their bullish outlook for the rest of this year, okay? Ethereum's ETFs quietly pulled in 114 million. We've seen a lot of outflows recently, but in October it was positive. So institutions aren't leaving the game. And if you watch my previous videos, this is now an institutional game. They're not leaving, they're rebalancing, and it's definitely shaking out weak hands, and people are running because people get freaked out when the market drops. And more kudos to people getting freaked out, because nobody likes to see their portfolio go down. So I have no problems with people getting freaked out. I just know for me personally, I'm holding on to my positions, and I still think that we have a good chance of a run in the next 2, 3, 4, 5, 6 months. So I'm holding on to my positions, and also I'm in Bitcoin for the long run, and so I'm not selling out my Bitcoin. And I do think that we still have good potential per this data and research for more of bullish sentiment returning at some point. Okay, could be choppy this week, next week, could be choppy, the week after. Who knows? I don't have a crystal ball in the short term, but I think the long-term indicators look good. Also, this is another bullish indicator. The Fed injected $29.4 billion into the repo markets overnight. So that's a liquidity injection. So basically, when they inject money in there, they're basically loaning money to the banks. So that's what a repo is. And so that's liquidity pumping into the system, which tends to be good news. Okay. And then you have another little quiet revolution happening with stable coins. If you've watched my previous videos, you've heard me talk all about stable coins, all about Ethereum, and lots of the stablecoin market is on Ethereum, about 60%. If you look at the institutions, there's many institutions that are building on Ethereum and on the blockchain, like lots and lots and lots of institutions. So we know that crypto is not going away. We know that the blockchain is a superior technology. We know that institutions are moving there quickly, because you just can't, in a traditional financial system that's very, very slow. And again, I'll say this again because it's such an important point. When it takes 2 days for you to sell a stock and for it to settle, when it takes 1 day to send a wire transfer, internationally 3 to 5 days to send a wire transfer, when you have intermediaries, which basically means middlemen, when I want to go from bank A to bank B, and there's so many middlemen who are taking a piece of the money and the fees in between, and there's so many employees that need to be staffed to do this, the costs are way too high. They're too high for the consumer, they're too high for the banks and the financial institutions. So there's no question in my mind, like 150 million %, that the banks and financial institutions are moving onto the blockchain. It's already happening, and it's not going to stop, which is a very, very bullish indicator long-term for the crypto market, which is why I'm 100% certain that Bitcoin in the long run is the right play. Okay. And also I believe that chains like Ethereum and Solana are also the right play. So when you look at the stablecoin market, if you kind of look at this marketplace, you basically look at this, and one day we'll see the stablecoin market, which is labeled as digital dollars. You'll just call it dollars, because all the dollars that exist in the system, or a big portion of them, one day will move into the stablecoin marketplace. Why? Because if you want to move dollars, why would you move dollars through banks when you can move them on the blockchain? And if you move them on the blockchain, it's cheaper, it's faster, it settles faster. You can send them in seconds to people all across the country and all across the world, and you can go across borders. So there's no competition. So there was a great interview that Anthony Pompliano gave the other day, and he was interviewing this guy, and the guy said, basically, you won't say digital dollar anymore or stablecoin. In the future, you just say dollar, because most of the dollars will be moved on the rails of Ethereum and other blockchains that can move it at the speed of light. Nobody wants slow money, and the current financial system is slow money. And so when you look at the stablecoin marketplace, this is just pointing to the future bullishness of the crypto marketplace. Like, there is no question whatsoever in my mind. I would bet it, as sure as I'm sitting here, that the crypto marketplace in terms of blockchain technology will lead the future. It's one of the most important innovations that has come into our financial system ever. So, whether we go through bearish times right now and things drop as they have been dropping, ultimately the future is incredibly bright for Bitcoin, okay? Incredibly bright for Ethereum, incredibly bright for BM&R, incredibly bright for MSTR. And if you look at the stablecoin market, it's now rivaling the world's largest payment networks in transaction volume. Huge amount of transaction volume going on, okay? And what you see here is they now account for 2.3% of all global payments, with a staggering $46 trillion in transaction volume. That's massive over the last year. Massive in stablecoins, okay? That's more than Visa and PayPal combined. So you've got a big marketplace coming in the world for the stablecoin marketplace, which is big for the blockchain. And, Trump has made it no secret. There's no secret whatsoever that Trump is behind the initiative of crypto. If you take a look at Trump and what he's been posting on X or whatever he posts on, he thinks that the crypto is one of the most important initiatives in the United States right now. And as he met with China, China is moving heavily into crypto too. So you have nation states moving into it. You got 12 different nations around the world that are mining Bitcoin. You got France that's declaring that they might actually get into Bitcoin and buy Bitcoin for their treasury. You got so many indicators for the future of this asset. So regardless of what happens short term, because we could take a dump, Bitcoin could go down to 95,000 or below. Long term, this is a good hold for me, not financial advice, which is why I continue to hold it. All right. And strategies in the crapper right now. I'm not selling strategy when it goes in the crapper. It's down at 240 or whatever it's at. What's it at right now? Even if it drops down to 200, I'm not selling strategy. Okay. Again, my investment decisions are not yours. I got into strategy when it was my first buy was at $78. Okay. And most of the strategies I picked up was around the $100 price point. All right. So when you look at this, there's very good indicators for what's happening in the future. China's getting into crypto. The U.S. is their main initiative to get into crypto. So we have lots of indication of what's happening. And if you watched my video yesterday, I'll just give you a quick recap on it. You really, if one gets the magnitude of the fact that, and again, if you want to learn like what I'm doing in bearish times right now, like I'm going to go take a look at this real quick. I'm going to get out of a trade pretty soon here and, pick up another bunch of shares of BM&R. So I trade BM&R every day. I think BM&R is going to drop a little bit more today. So I'm going to let it drop more so I can pick up more shares because I sell out of it daily and then I buy back in. So when BM&R is dropping, for example, when it was down at 40 in September and August, I was picking up for 3 weeks, I picked up $60,000 worth of shares of BM&R when it was at the $42, $43 price point. So when the market drops, I'm trading to pick up and buy more shares. And somebody asked me yesterday, how do you do it? It's a very simple concept. Like right now, if you look at BM&R and you look at the charts for BM&R, I'm not going to go to the charts now, but if you look at the charts for BM&R, you got BM&R sitting at 41.28. Now a sell signal came in at $42. So the sell signal for BM&R came in at $42 is now at $41.31, right? So basically what I do is I look for a sell signal on BM&R, and then when the sell signal comes in, I sell out, and then I wait for it to drop, and then I buy it back. So yesterday when I picked up another 100 shares of BM&R, there was a sell signal, and then I bought it back. And I made a crappy trade yesterday. I should have waited a little bit longer. I could have picked up way more shares, but 100 shares, which is about $4,500 worth of BM&R on a crappy trade is not bad. Make sense? So I believe in being cause over the markets. And so when the markets are down, I'm still trading. When the markets are up, I'm still trading with the stock that I want to trade, which is BM&R, because I'm bullish about BM&R. And I believe that it's the next MSTR. And so I'm just going to continue to trade it, pick up more shares. Market goes down, I pick up shares. Market goes up, I pick up shares. Market goes way up, I win big. Market goes down, I win by picking up more shares. Okay. So somebody's asking, do I sell the whole stack or just part of it? I actually, today I sold the whole stack, but I sold the whole stack today. Yesterday I didn't sell the whole stack, but today I sold the whole stack. But it's not my whole stack of BM&R. Like I have another account that has BM&R in it. And so what I do is like that other account, it's just sitting there and I'm holding BM&R. And then I have my trading account and I sold the whole stack out today. There might be a few, there might be a little bit left in there, but mostly the whole stack I sold out today. Okay. So, and I'm willing to take that risk in a bearish sentiment type environment. If we were in a more bullish scenario, I wouldn't sell out the whole stack and to be more cautious about my trading. But again, it's how I've been profitable over the last 15 out of 16 weeks. Okay. So point be told, here's the reason why I do this. And I'm just going to break this down. You should, if you want to get a video on how I trade, go down below. It comes with my book. So you go get my book And then I literally show a video of exactly how I trade. I show you the indicators of what I do. It's all down below. Just go snag it, okay? Go click on the link. It'll take you to a page where it says download my book, and you will get an email that sends you the book. And then you will also get an email that sends you a video. And there's 2 videos in there, and one's a trading video, and it shows you exactly what I'm doing, okay? Okay? So that's how I make money when the markets go down, all right? Now, the reason, and I'm just going to repeat what I said yesterday because some people missed it, but the reason why I'm so bullish on crypto, and the reason I'm so bullish on BM&R, and the reason I'm bullish on MSTR and Bitcoin, and again, if it doesn't hit the marks for me in Q4, I'm just holding, okay? And there's no way in God's green earth I'm selling BM&R right now. It's just not happening. I sell and buy back the same day to add to my position, you see? But I'm not selling it to stay out of the actual stock, because I believe we're going to see in 2025, 2026, BM&R, I believe, is $100 play. At some point, it's going to hit $100. I think it might happen in 2026. So I'm holding on to it. Now, if we go into a bear market, then that's not going to happen. But I'm still playing the fact that I still think we have ways to go. So with that said, here's why I'm bullish. Here's why it's the only choice for me. I'm going to tell you this is why it's the only choice for me. So if you look at basically, there's a hidden 15% tax or drag on every American's investments. All right. And so, and I shouldn't call it a tax, but we should call it a drag. And this is why America and people all over the world are running hard and staying still. And this is uniform for countries all across the world. Okay. So when you look at inflation, inflation's told to be around 3%, but that's only part of the story, right? The real inflation rate for most Americans when you add in taxes, when you add in asset inflation, all the things I'm about to show you, the real cost and drag on your money is about 15% a year. And so when you break it down, you face basically 2 kinds of inflation, right? So if you're a homeowner or you want to buy a home one day, the first thing you face is consumption inflation, like your food, your healthcare, your energy, all that stuff. And that's what the Fed talks about on the news, right? They talk about, hey, CPI, the consumer price index, basically what you consume on a daily basis, monthly basis, and 90-day basis. And so they report that as 3%, but that's not the real drag on your money. And so people are like, oh, inflation's good right now. Inflation's dropping. And that's bullshit, man. It's not, okay? So the CPI might be dropping to some degree, but that's only 3% of the drag on your money. There's another 12% that drags on your money, okay? You got asset inflation. So anybody who wants to buy a house or anybody who's bought a house, the housing market doesn't go up by 3% a year, man. All right? And your mortgage payments are not 3%. They're on average over the last several decades, 7%, and that's being low. So when you buy a house, you're taking into account when you want to go buy a house, I'm saving for a house, I want to buy a house. When a house is going up 5% more a year, when you eventually go get the house and you have financing costs, you're paying another 7% interest on that, on your loan. So your asset inflation needs to be added into the equation, which is not included in CPI. They include rent and what's called owner's equivalent rent in the CPI. That assumes that everybody would rent the houses that they own. But that's not the true cost of asset inflation. Asset inflation, when the house goes up, it costs more money to buy the damn house. So you have to count that as a drag on somebody's money. If you don't count it, then it's not being real. And so rising home prices, mortgage costs, property taxes, you got to account all of that as drag on people's money. So when you look at CPI, the true inflation number of CPI, let's say is 3%, but housing inflation, you got to throw in another 2%. Mortgage interest, you could throw in another 5%. Now you would take an average of these, and then you have taxes, you throw in another 2%. So I'm not saying it's 5 plus 2 plus 2, which is 9. But what you're looking at here is if you were to look at CPI and inflation at 3%, you can't just say that the regular inflation is 3%. You would have to add another 2 or 3% to that number with housing, mortgage costs, property taxes. So a lot of people in the world own homes. So the real drag on your money is not 3% a year. It's more like 5 to 6% when you add into account asset inflation. So even if your investments earn 10%, you're really closer to zero, because then you got to take into account taxes too, right? So if you take into account a CPI of 3%, if you take into account asset inflation with houses around another 2%, 3%, that's 6%. Then you minus out taxes of 2%, you're at minus 8%. And that doesn't even include the debt that one pays. That doesn't include the debt that one pays on their actual their debt interest, right? So if you look at debt interest on what somebody pays on their car loans or somebody pays on their credit cards, you have to factor that in too. And then you look at the debasement of currency that's happening as well. You got to factor that in too. So the real cost on your money is not 3%, the drag on your money per year. The real drag on your money every single year is closer to 15%. So let's say around 13 to 14% drag. And even if you don't own a home, the real drag on your money is 11 to 12% anyway. Because one day you might want to buy a home, and that's going to cost you more money than a 3% CPI inflation that they report on the news. So, it's just, it's what's being presented to the public is just not fully accurate. So even if you own a property, and you're paying financing costs on that, property taxes on that, like there's a huge drag on your money. And then even if you don't own a property, there's drag on your money. And if you look at the U.S. household disposable income, it's about $25 trillion per year. Okay. So that means that's what people take home after taxes, $25 trillion per year in the U.S. But you look at the total household debt of the U.S., it's $17 trillion. And the annual interest payments alone are $1.3 trillion. So the drag on your money is not 3% a year. Don't listen to it. It's not true. Okay? It's not true, because that would then allow somebody to buy into the story that you can earn 12% a year and you can still go get ahead with your investments. And that's not true. All right? So you're barely getting ahead. Barely. And like if the drag is really 13 and 14% on your money, you're negative. So you got to look at the total rate of return on all your money. CPI is 3%. That means Americans are doing well. They're going to be totally fine. Earn 10% in the stock market and you'll be fine. Whoever sold that load of a story for the last 2, 3, 4 decades sold a load of a story. It's a load of a story. That's all it is. Okay. So that means Americans pay 5 cents of every disposable dollar just in interest every year. So you got $100, 5 cents is interest to your debt. Should you include that and the drag on your money? Yeah, you should. All right. Okay. So let's see where the $1.3 trillion in interest goes. Mortgages, people pay $720 billion in mortgage interest. Auto loans, $130 billion. Credit cards, $260 billion. Student loans, $80 billion. So $1.3 trillion in interest is being paid. You have to count that as a drag on your money, period. If you don't, then you're not confronting the facts. Okay. So that's the hidden tax of debt. And it's not optional because most Americans and most people around, a lot of people around the world have it. So even if you're responsible, you're paying for a system that rewards borrowing. Okay. Think about it. Stock market returns average 10 to 15% a year, but the real world cost drag on your money is 14 to 15%. So if stock market returns are 10 to 15% and the drag on your money is 14 to 15%, what are you actually making? You're making zero, zilch, nada, niente. Okay. That means your portfolio grows, but your purchasing power doesn't. And this is the big lie. You see what I'm saying? Like the portfolio grows, but your purchasing power doesn't grow. So that's why people are walking around and they're going, oh, I'm going to go buy a house. They're like, why can't I afford a house? Or, oh, I want to go buy this. Why can't I afford that? Oh, I want to go buy that. Why can't I afford that? Okay. So if you own assets, you're barely staying even. If you don't, and there's 50% of Americans that aren't invested in the stock market, that 50% is going broke, and it's not fair, man. Okay. You got about, I think 12% of Americans own like 88% of the stocks. What about the rest of the population? They can't even keep their head above water. They're drowning. Okay. So yes, the takeaway is simple but powerful. The system keeps wealth stable for those who already have assets and drain those who don't. But stable, it's not stable for you if you own assets either, because it's not stable. You're basically not making money. Okay. So U.S. households owe about 2/3 of what they earn each year. Okay. That's huge. Households owe about 2/3 of what they earn each year, and interest alone drains $1.3 trillion annually, a built-in debt tax. You live in an economy that's built on debt. That's what we live in. Okay. This economy is built on debt. That's how it works. The whole system revolves around debt, and the banks make money off of it. And the financial institutions make money off it, and the American public and people across the country have very similar systems, go poor. Not too hard to understand. Okay. So to truly get ahead in the system, you got two options: either earn returns above 15% or drive your debt to zero. Okay? That's the option. And that's what exists for the public out there. So when you really look at the data, it's so funny. If you look at the S&P 500 returns around 15% this year, what's the drag on your money? 15%. It's just so hysterical to me that like the S&P 500 is doing 15%. It's doing so well. The market's doing so great. Okay. But the drag on people's money is 13, 14, 15%. So essentially people are earning zero. All right. So that's what's going on in the market. And so you got two options. You stay in traditional finance and you basically, if you have assets like houses and you're invested in the S&P 500 and you do all of that, you basically tread water. Hence, look around. It doesn't take a genius to look around and observe and go, how is the rest of the world doing? How's the world doing? If the stocks were so good, if the system was so darn good, people would be wealthy. Okay. And the majority of the world is not wealthy, or they'd at least be living a good lifestyle. And the majority of the world's not living a good lifestyle. There's the apparency of a good lifestyle when people are in debt. So they keep up with the Joneses by having the nice cars. And the middle class is the biggest trap ever, because the middle class has the apparency that they're doing well. They drive the nice cars, they have the nice house, and they're mortgaged to the tilt, and they're in debt. That's what's going on, man. That's the weather in the sports. You know what I'm saying? So you have an option. You stay in traditional finance and you tread water, or you make different moves. You know, for some people, crypto might be the move. Bitcoin might be the move. Ethereum might be the move. BM&R, MSDR. I'm not giving any financial advice. I'm saying that could be the move for some people. And so for some people, AI stocks, they might get involved in AI stocks could be the move. You know what I'm saying? So the question is, what are you going to do? You know? And so everybody's got to come up with their own plan, but the facts are on the table that one who stays in traditional finance is going to get bled dry by traditional finance. I was on the phone with somebody yesterday helping them, and I'll have them remain anonymous on there. And I was on the phone with their financial advisor, and I just said, hey, can I just ask politely, what is your management fee? What do you charge? You know, it's 1% a year. Okay, great. Pull up the portfolio. How's the portfolio doing? You know, what are you invested in? We're 50% invested in the S&P 500. Great. Like, I don't need a fund manager to invest 50% of somebody's portfolio in the S&P 500. Anybody could do that alone. Okay. What's the portfolio returns? Like, you know, some of it's in bonds, right? Okay. And then some of it's invested in XYZ. So it's like, okay, well, let's just say, for example, that this is a $2 million portfolio. And a fund manager is taking 1% per year. I did the math. If you take a 1% fee on a $2 million portfolio, and let's say the portfolio is going to do 10% over the next 20 years, guess how much that 1% management fee is? It's $600,000 to $700,000 over 20 years. But if that $600,000 to $700,000 fee was not taken, and it was in the person's pocket versus the fund manager's pocket, that $600,000 to $700,000 would have grown to $2.2 million over 20 years. So essentially, this person loses 20% of their gains by having somebody manage their funds with a 1% management fee. This is real stuff. It's the real stuff that's going on in the world today. I don't mind somebody getting exchange for what they're doing as a fund manager. I have no problem. I want them to get their exchange. But to make 20% of somebody's returns over a 20-year period and put it in your pocket when 50% of it's invested in the S&P 500 makes no sense, right? So that's basically what's happening in the world to the American public. You need to go check your actual investments. You need to check your financial advisor, what they're charging you. You need to do the math. And listen, like, I want everybody to win, but I don't want people who have fund managers to lose and not be able to retire at the expense of the fund manager. That's not a fair game. Like, somebody should be adjusting and going, hey, like, you may not have enough money to retire. Let us adjust our fees. We can still want to win and get paid for what we're doing, but I want you to win too. Like, it needs to be a win-win game. And you know, that 1% where people are like, 1%, it's no big deal. When 1% ends up being 20% of your portfolio, it's a big deal. That's what's happening in the world, my friends. So hope this serves you. This is why I'm so passionate about this. That's why, I mean, I've been in finance since I was 21, okay? And I was in financial services at 21. So for those of you who don't know me, I was the guy in the classroom asking all the questions like, why are the management fees so high? Hey, I don't understand why. Like 10% seems crappy, man. Like, why do I want a 10% rate of return? Like, that seems awful. Like, credit cards charge 20 to 30%. Why can't I get 20 to 30%? I was asking all these questions at 21 years old because I never bought into the idea that like all of this stuff would work long term. Okay. So ultimately, you have a choice and you need to make the best choice for you and your family, but you need to know the facts. And that's what I laid out on the table here. So you can go get my book, Money Game. It gets more into the facts. I've talked to so many people who've been on YouTube, who've been reading the book and are enjoying the book. Also, for those of you who are interested in making money when the market goes down as well, meaning picking up more shares. Like, listen, when BM&R goes down, I lose money on paper too. I just lose less, okay? Because I'm picking up shares. And so I bought in BM&R when it was at $60, but I've traded it all the way down. And so I'm picking up shares almost every single day of BM&R. So where the effect for somebody might be a 30% drop with BM&R, it's not a 30% drop for me. Make sense? Okay. Because I'm picking up more shares, more shares, more shares. And when this thing goes back up, which I expect it to, you know, there's a huge win when it goes back up. Okay. I hope it works for you guys. Hope you have a great rest of the day. Stay well. Grab my book. Go grab my trading video down below. It comes with the book, and you can see what I'm doing. I'll see you guys soon. Have a great rest of the day. And I hope things turn bullish for us.